when I entered, Sunil was talking about the AIF industry, and clearly they have grown, leaps and bounds. And within that, clearly, the private credits, which is obviously the subject matter of our discussion over the next 40 minutes, is always, has been, credits have been in the eye of the storm for whatever right or wrong reasons, and then making a comeback is really a very interesting thing. And it's even more pertinent to note, at a time when sovereign bonds across the world are saying that रिश्ते में तो हम तुम्हारे बाप लगते हैं, नाम है government securities. At that point in time, corporate bonds are saying that हम credit है तो क्या हुआ, return generation वाले हैं. So I think on that note, I would like to start off, Hemant, I will start off with you, right to my left. We saw this data, and when I was seeing this data, actually I was reminded, Cat 1, Cat 2, Cat 3, highest growth in the Cat 2 segment. And I know you're not a big Bollywood fan. I'm aware of it, but you would have seen this movie Kalia, Amitabh Bachchan?
I have.
Yeah. So in that there's a dialogue, हम जहाँ खड़े होते हैं line वहीं से शुरू होती है. So category 2 AIFs are actually, kind of following that sort of a trend. More than 80% of the total commitments raised. What is really driving the investor interest here?
Yeah, I think category 2 takes the limelight as of today. I'm hoping the other categories also grow as faster. It's not that category 2 presents anything very different and unique from category 3. I think category 3 funds in India obviously do have a higher tax slab. Category 2, the very fact that tax is a pass-through is a big enabler. Plus, most importantly, I think what can be done in investments, I think category 2 is a more broad-based, listed, unlisted, credit, equity, private equity. In fact, in my view, 80% of what can be done in alternatives can be done through Cat 2. And that's the reason why Cat 2 is growing leaps and bounds. So in a nutshell, it's like 80% synonymous with alternatives, and which is why you're seeing Cat 2 growing.
And you think that trend will continue?
I think, as Sunil pointed out, I think the overall trend of alternatives will grow. And Cat 2 being 80% representative of alternatives should take the big limelight, even going forward. It has private equity funds, it has private credit funds, it has real asset funds. So that's like 80% of the alternative asset industry in category 2 format.
So Aakash, the leading question to you is, within... so for example, from Apna time aayega, that is what we used to say back in 2019, 2020 with respect to credit, at the time when credit, confidence in the credit industry was getting shaken. So from Apna time aayega to Rocky Randhawa this side, credits have actually made a significant comeback. So, and this is not just in India, we are seeing this trend globally. So are you seeing this more accentuated in India? Are you seeing relative to the globe, we are way better, more pronounced? Any trends that you can throw some light on?
In terms of, so the way we look at the market, Lakshmi and everybody else, is that we think that alternatives are, in a colloquial way to speak, here to stay. Globally, if you look at any data across the board, alternatives and real assets, credit and real assets are the fastest growing asset class. And that's primarily because they are a anti-fragile, anti-volatility asset class that gives investors stable-ish returns. And against the backdrops of inflation, interest rates, geopolitical challenges globally, these two asset classes have emerged as the best asset classes for investors. Domestically, I think, if I look at the overall markets here, right? For a long time, investors have not got access to these assets before. Cat 2, to also answer the previous question, gives you an access path into these asset classes, which, if you look at any data across the board, is going to grow substantially over the next 5-7 years. We've looked at data to say, just look at private sector capex. Your average for the last 5 years was 3.7 lakh crores per year. It's going to 6 lakh crores a year for the next 5 years, right? that's simply a huge amount of capital that's going to be needed, and we don't think the public markets can give that data. Banks and NBFCs have struggled to provide that liquidity, and hence all of that is going to come to some pool of capital that's going to be able to cater to that demand, right? So all in all, whether I look at demand, whether I look at lack of supply or supply of capital constraints, the industry is going to grow substantially. And also that's happened globally, right? If you look at alternate assets in the US and Europe, credit used to be 4% of alternates, it's now 22% of alternates. Yeah. So within a growing base, the growth rate's even faster, which means it's acquiring a lot more market share or wallet share, so to speak, from the other alternate asset classes.
Here is the case where we say that past mein jitna bhi andhera ho, future is always bright. But here in our case, the past also, the recent past is suggesting a very positive trend, and the future is looking even brighter, and we are just ahead of Diwali, so the brightness remains. Karthik, I'll move on to you. Are you also a movie buff, or you don't watch movies too?
I do watch some movies, but obviously
have you
not
seen the movie Anand? Where
yes,
Rajesh Khanna, so where he says that zindagi badi honi chahiye, lambi nahi. But when it comes to real estate, it is always lambi judai. It's always a long gestation period. You are identifying, opportunities. You typically vary of lending to real estate sector with a 1-2 year perspective. So the question to you is there a scope within this space for real estate funds to flourish? Is there an investor perception significantly different when they evaluate funds in the RE space compared to the rest of the pack?
So yes, there is. But just to sort of add on to what my colleague said, the interesting thing about the space, and indeed driving real estate financing also from an alternatives perspective, is that, if you just look at globally the situation, particularly developed markets, 80% of risk financing is done by alternates, non-banks. Exactly the opposite in India. So it's 80% by banks. So that trend is irreversibly changing over the last decade and will continue to change over the next several decades. And to put this in perspective, this data point, India, as Sunil said, is a 3.75 trillion economy, right? But at the end of the day, the alternatives market is still extremely nascent. So a lot of the things that we do in terms of styles, strategies, including real estate and so on, you superimpose on an economy that's 3.75 trillion, but still considered very young and growing. So a lot, I won't say that you should do bad deals, but a lot of interesting potential and returns get released just because of the momentum of the economy. So real estate is no different. So the answer is, to Lakshmi's question, yes, investors definitely have a very different perspective when they look at real estate versus several other funds. I think the proof of the pudding is on this dais, where, at least to my knowledge, 16 funds have raised corporate credit funds in excess of 1,000 crores in the last 8 to 10 months. So everyone is positioned as a non-real estate corporate credit fund. And in real estate funds, there probably are 3 or 4 funds, don't want to name them. But there are a lot more people understanding that real estate as an asset class provides a solid base, and there is a process of education to understand that, okay, it's a tangible asset, there can be a bid on it. So effectively, the education has to continue for investors to perceive real estate as a prime and core alternate asset class as it is perceived in Europe and the US. So it is very prime. So the sector itself is obviously, doing good things. I'm not even going to talk about the last 12 months where it has outperformed by 40-50%. But over the last 20 years, it has gone from 0.5% of the economy to now pushing, I read Anarock somewhere, 9 to 10% of GDP. So the sector is here to stay, very deep, very sustainable. And to your quote on movies, I cannot be as eloquent as Lakshmi on Bollywood and movies, but I think the future is strong and very, very sustainable. So I think there is a definite case to be made that this is a very, very viable asset class.
And interestingly, this performance comes at a time where back-to-back in 2 years, of course, 2023 is still not over, REITs globally have been the worst performing asset class. And at that time, the physical asset class called real estate has actually held up pretty well, whether it's your house or whether it's investing in a real estate fund. Moving on from Lambi Judai, Apurva, I'll come to you. Again, Sunil referred to Gulab Jamun in his morning discussion. So Gulab Jamun, though we all know, but how many of you have had Bombay Sweet Shop's Gulab Jamun churros? I think very few people, or so that's venture debt. So the question to you is that in this world of gulab jamuns, or in this era of gulab jamuns, where does venture debt hold its position? Number one, are there enough and more investment opportunities within this space to create a basket and run it for investors?
Sure. So venture debt is, almost 7-8 years old in India. It started with the US, where it's more than 25 years old. It's very evolved, very mature. Venture debt, in terms of penetration, it's roughly about 5% of the venture capital money that flows into the economy every year. So the per annum deployment roughly is about $1 billion. Of course, it's much smaller than so many other AIF Cat 2 categories. But venture debt has a flavor, of entering new age businesses without actually taking a lot of risk. So venture debt has two components of return. Apart from the regular coupon, which a private credit fund also gives you, there's an equity kicker in the form of warrants, which can add significant 5 to 6% to your returns. So average venture debt funds have been distributing about 18-19% net return to investors, which is with a far less holding period, far more recurring, predictable cash flows. So generally, people who enter venture debt are people who are allocating a part of the venture capital deployment to venture debt. But they don't want a 10-year horizon without liquidity, mark-to-market, paper realizations until there is substantial distribution that the fund has made. This gives you a shorter holding period, much more recurring, predictable cash flows, which is your coupon, plus that warrant upside in the form of an equity kicker, can mirror venture capital returns, but much more safer in that sense. So in the, venture debt has really evolved, picked up a lot of pace. It's growing very fast. It's growing actually in the last 3 years. If you look at the venture capital deployment, it's been degrowing because 21 was a, year where, all FDI was being diverted from China into India. Venture capital shot up to $36 billion, and then 22 it fell to 25, and this year probably it'll land at $11-12 billion, which is what it was in 2020. And probably grow at, sustainable rates from here on. But venture debt in the same period has not been degrowing, it has grown every year. But in some sense, it's a married asset class, so the venture capital industry has to grow for venture debt also to keep growing. It can't keep growing in silos. But yes, there are more players coming into it. There's a lot more education. A lot of investors understand this asset class far better than they did a couple of years back. So yes, I'd say that there is ample opportunity, but it's still a very small penetration compared to the venture capital deployment.
No, undeniably, and I think at least those baby steps have been made, though you did mention to the, allude to the fact that it's been over 7 to 8 years. I think in terms of investor responsiveness and investor awareness, it's still relative to the other category of funds, it's still at a nascent stage. So for all those in this audience who love lemonade, please understand and realize and now be aware there is also a charcoal infused lemonade. Anyway, I will come back to the focus on the private, the credit space. And Hemant, I'll come back to you on this. And I won't ask Hemant this question. Have you all seen this movie, Bunty or Bubbly? I'm sure most of you would have seen, very old movie, right? So, usme there's a very famous dialogue which says, "ऐसा कोई सगा नहीं जिसको हमने ठगा नहीं." Now, one would wonder what is the correlation of that to private credit. My question is, there could be in this entire space, irrespective of however well we do our research, there could be default kind of scenarios. Far too few right now, but nevertheless. How evolved are practices in terms of risk management to give investors the final comfort that, despite the thugs of Hindustan, we clearly have these underwriting standards to ensure that there are fewer accidents as we move along and see exponential growth in this space?
Good question. I think when it comes to credit, the first thing that comes to people's minds is thugs. And my biggest learning in the world of credit in the last 10 years is very different. जब हम Uber में बैठते हैं, right? When we onboard on a Uber car, and the Uber driver suppose we just cancel the Uber. Uber just pays us the money back, right? It doesn't question you why you cancelled it, correct? It's a complete trust situation. Unfortunately, in credit, you know, whenever you start thinking of an adversarial relationship. As if you've given money, सामने वाला तो चोरी है, and he will ठग you, right? ऐसा होना नहीं चाहिए. Because when you're giving money, that money is valuable. And it ideally should be a win-win situation. If I have given money to you, with my money, your productivity is actually going up. So it's actually a win-win alignment. In the business of credit, fundamentally, your money should add value to your productivity and end up in a win-win situation. I think that is the holy grail of doing successful credit. As a mindset, both as an investor and as a borrower. So yes, I think at Neo, we specialize in win-win situations. Our money should add value. Money itself can solve 80% of the problems in life. And I think adding money is a valuable commodity to getting added. Now coming to Lakshmi's questions, two other things that I want to answer on risk management. I think fundamentally a lot has changed in India. If you look at the last 7, 8, 10 years, I think post the IBC coming in 2016, there is a fundamental shift in the credit culture. Companies, promoters can lose their companies, you know, when there is such a threat, the corporate culture is changing. Large corporate houses have lost their primed properties. So basically, there is a culture that is changing. Even the borrower is acknowledging that the culture is changing. And the third thing I want to add from risk management, see, in the business of credit, there is only one thing that matters, and that is cash flow. When you're lending to a business, is there cash flow in it? That is your biggest line of defense. Obviously, collateral will be there and whatnot else. Cash flow is the most important, so you should lend to cash flow additive businesses. And सबसे important चीज़ क्या है कि portfolio diversify करो. Despite cash flow, despite collateral, ability है, intention है, सब कुछ है ना, उसके बाद भी diversification करो. If you have 20 companies in your portfolio, and this is a very important statistic, Lakshmi, I want to share with everybody. If you have 20 companies in your portfolio in a credit fund, and something goes wrong with one, say it doesn't pay you interest, you lose 30% of the principal, right? And you are targeting 20% returns on these 20 companies. Say in one company you don't get interest, you lose 30% of the principal. How much will the returns come down to? Your 20 will mathematically come down to 18.7, right? So it's not that the 20 will vanish and go down to a 2 or a 4 or a 6. I think finally diversification is the holy grail of risk management, whether it's gulab jamun, jalebis, whether it's asset allocation, you need to diversify. So yes, in credit, 3 things for me: win-win relationships, cash flow, and no matter how confident you are, just go and diversify.
So bottom line is, top line is vanity, bottom line is sanity, but cash flow is reality. I think that is the
Absolutely.
Gita ka saar, if I were to say. An extended question on that, Aakash, is that, and I'll not quote no Bunty Bubblies, I'll quote fairy tales. We've all grown up as kids, seeing these fairy tales. Now, there the prince is actually chasing Cinderella, despite knowing the fact that Cinderella, at the stroke of 12, her cart will become into pumpkin. Her shoes are going to be completely gone, and she has cut-off times. And therefore, it's a slightly more difficult thing to pregnate. If I use that analogy and extend that analogy in the credit space, banks typically are a more potent, durable, and a cheaper source of funding compared to AIFs, specifically on the private side. Why is it that issuers are making a beeline towards this Cinderella, or are they seeing the princess in the Cinderella, which none of us can see?
I was actually listening to the question and thinking, where are you going to go back to credit from Cinderella? But we get this question asked to us all the time. In fact, yesterday I was with a global investor who's got 54 billion AUM, asked me the exact same question, saying, regulatory arbitrage, saying banks can't do M&A, banks can't do special states, banks can't do cap market financing, can't be the sole basis of a huge business model, right? What if that changes? What happens to the whole credit space? And my answer was a bit of three parts, right? One, currently there is regulatory restrictions. I don't see RBI becoming very, very free with public depositors' capital and hence saying you can do what's deemed to be riskier or more non-plain vanilla investments, right? So we see a lot of differentiation in the amount of risk that banks will be allowed to take and non-bank entities or accredited investment vehicles will be allowed to take. Secondly, I think speed and complexity, I'll put that in one bracket. It's a massive differentiator. There's a lot of situations which we spend a lot of time on. We really try and understand, and the amount of work that, I mean, I've spent 18 years out of 23 in banking, and really understood that banks are structured to look at more plain vanilla, but size, right? Banks are built on size and built on scale. So doing small ticket, what's called low return on time investment type investments is not where banks are geared for. Having said that, I think the answers in the RBI capital adequacy framework as well. See, banks are told inherently that if you lend to AA companies, your risk weight is 20%. So to make a 100 rupee loan, you need to keep 100 rupee ka 9% ka 20%, right? So 1.8 rupees with RBI as capital. The moment that goes to a single A or a triple B, the capital ask goes up 5 times or maybe even 10 times. The risk weight increases so substantially that lending to those companies, lending to those businesses is highly non-ROE accretive or punitive for banks. Given the competition in the banking space, given the equity market pressures, given investor scrutiny, most banks are very comfortable and rightly so, happy to lend at 9, 10, 11% to better rated businesses because that's a better ROE multiplier than lending to companies at 14, 15%, even though they may be safe investments. And hence, it's a little bit of all three where we see banks continue to play in the largest size of the economy, working capital, term loans, overseas investments, and alternate pools of capital like ourselves and across real estate, credit, infra, venture debt, will be left to more, I would say, savvier, complexity-driven investors who can look at that alpha and use that alpha to be able to look at better quality companies, generate track record. I mean, ultimately, I think track record is king. One can use, like a chef, use various forms of cooking a great dish. But ultimately, if you can keep doing the same dish year after year after year, then you're really a great chef, right? So I'll use that analogy to say track record is king. Each of us have a secret sauce that we'll tend to employ. Somehow it will be cash flow, diversity, real estate, better quality borrowers, better PE investors on the cap table, what have you. If you can get track record and if you can show investors that across cycles, you've been able to return capital and generate returns, then I don't think liquidity is going away in a hurry. We also have a very large wealth business that sits alongside us, and this is what we sort of look at. Financial total wealth AUM in India is 430 billion, right? 2023 data. 380 billion of that is financial assets. Investors are getting wealthier, savvier, generating more returns, and hence we look to differentiate between saying how much of my money is locked in high grade, bank deposits, CDs and what have you, and how much can I move to alternate assets. And within that, is there a differentiating layer, right? Can someone say, I understand high grade, low risk credit? Can someone say, I understand performing credit, I understand special sits, I understand real estate, venture debt, so on and so forth. So we think investors will start segregating over time and really looking to say, in my investment thesis, where is the best risk reward ratio I'm getting and allocate capital to that space.
So basically, the faith and the interest is both ways. It is from the issuer perspective, it is also from the investor perspective, and obviously from the manufacturer perspective. And it doesn't take two to tango, it actually takes three to tango. Karthik, Aakash mentioned about dishes. In the real estate world of dishes, the most favored dish is property. Buying land, buying physical houses or commercial real estate. So in that kind of a popularity scenario, if the Bade Miyan in real estate is actually buying physical property, why would investors or why should investors look at the Chote Miyan, which is the real estate funds? Any thoughts on that?
Yeah, good question. In fact, fortunately for real estate funds, this question has been answered by investors over the last 8 years. I should think actually over the last 15 years. So I think the answer to this question lies in where they make more visible risk-adjusted returns, right? So if you looked at real estate as a sector from 2000 to 2010, maybe 11, barring the GFC blip, investors were consistently able to make 13-14% capital appreciation. Obviously, if you invested in Gurgaon in the early 2000s, you made like not IRRs, but you made multiples of invested capital. So there are markets like that which favor physical real estate. Over time, obviously since then, real estate markets in terms of capital appreciation has been choppy. Development has more or less started happening in the big 7 cities, as they say, the urban metros. And slowly the movement has started in terms of residential, demand for housing, etc., in tier 1, tier 2 towns and so on. So I think the sector has in many ways matured enough for investors to realize that unless they are extremely local, where they are in a particular micro market that's saying that, okay, 5 years back, if I were to look at Navi Mumbai and looked at buying a physical asset in Navi Mumbai, and that is driven by the fact that you're a resident of Mumbai and you're likely to use it at some point in time, and then you look at things like infrastructure, social infrastructure, all of that development, the choices have been very, very little across investors sitting in the 7 urban cities. So the automatic movement is then to funds. And within funds also, there has been a consolidation in terms of, who's consistently generating return to Hemant and Aakash's point, where, over cycles, over the last 7-8 years, I had somebody tell me our funds in real estate have had a vintage starting at the end of demonetization up until now. So I actually thought it was a pretty difficult vintage. But somebody came and told me, yaar, aisa se paisa bana chahta hai, because, asset prices were depressed, so, you can't. So I think, that's where I came up with the education point. But clearly the appreciation for putting money into funds, which are able to have strategies that generate money with a high degree of visibility and consistency, has come to be appreciated now. So, today I no longer have those conversations with especially HNIs, particularly sitting in this city, who think that Juhu mein flat kharid lenge, JVPD mein kharid lenge, 𝑣𝒂𝒑 ko kal maine mila hai, and all that, so all those conversations have gone. And as my colleague stated, the LP industry in India has also matured, where people look more at allocations rather than, okay, if I had 10 crores, do I put it in a flat in Juhu or do I invest it in a fund? So things like diversification, consequently allocation, what kind of risk, reward, all of that has substantially improved and improving, even if you are in early stages. So today, if somebody had 10 crores, they are saying that, okay, let me put 3 crores in this, 3 crores in this, 2 crores in this fund, and maximum maybe I'll go buy a piece of land somewhere. So I think that sophistication and the fact that India has gone through in any growing economy this kind of volatility on asset prices, and the fact that you have managers who've also matured, lived through accidents and mistakes, who are able to generate returns consistently, a lot more avenues in terms of where they can actually park money. So I think there is definitely a favor towards fiscal assets rather than physical assets, the way I see it. Not to say that there aren't capital bets that people take in terms of buying land and so on. I myself, looking at a piece of land, where I think I'm local in Chennai, so I understand, where prices are likely to go up. But having said that, a lot of my money, if not all, is in funds and financial assets.
So net the crux is, I think, though real estate, like gold, actually has a magnetic pull. And not just in India, by the way, this is, when you travel across the globe, it's a very similar kind of a feeling with respect to real estate. I think the crux and the key is the risk-adjusted return. Risk is the most forgotten four-letter word in bad times, or in good times rather. and in bad times, every other four-letter word manifests. So I think one needs to keep that in mind. At least you will not be like Abhimanyu in the Chakravyuh when it comes to real estate funds. Who knows, and who is confident whether we can say the same thing of real estate physical investments. Real estates, back to venture debt, Apurva, while we did establish that there is a reasonably good universe of opportunities, and now there is fair acclimatization of how gulab jamun churro looks like, or how jalebi caviar looks like. The question is there a yardstick to evaluate these new age companies, given that there are very few peer benchmarks in India to probably look up to, or there are very few innovators in the space. So is there some checklist that you as a manager would probably follow when you identify these opportunities?
Sure. So the evaluation criteria of venture debt is very different from bank credit, performing credit, private credit funds, etc. Obviously, the interest coverage ratios, debt service coverage ratios, all of that you can't really formulate, because about 80% of the deals that we end up doing are loss-making. So what do we essentially look at? First, because venture debt is a very small portion of the venture capital deployment, it is only available to the best of companies from the best of VC investors across sectors. Also, venture debt comes in after the company has raised, say, $4-5 million, generates revenue of, say, 2-3 crores per month at a bare minimum. There is product market fit. We don't come in at concept stage, paper plan stage. So we come in only after the product market fit has been established and the company has started generating revenue. It should be a category leader. You can't keep backing, say, the 5th or 6th player within, say, beauty and personal care. Because every industry has consolidation. Eventually, capital also becomes a moat. If you have the best of, tier 1 VC investors, domestic as well as global, eventually, they will be able to raise more capital, which will determine their market positioning. So essentially, a couple of factors. Once the company has raised institutional rounds of funding from high-quality VC or private equity investors, the company is a category leader, number 1, number 2, maybe number 3 player within a sector. We lay a lot of emphasis on the unit economics of the company. So what we, in the startup parlance look at is contribution margin. That is the company generating enough to take care of cost of goods sold or cost of service delivery, logistics, shipping, warehousing, customer acquisition cost. You can be negative EBITDA because you haven't achieved the scale to take care of your fixed cost. That's okay. But primarily, you can't be a negative gross margin business. Those companies will never attract venture debt. The other thing is, we stay away from any sector which has regulatory overhang. So no real money gaming, crypto, deep tech, which may or may not, be a mainstream technology in future. Those are equity risks. We take calculated risks for a short period of time in well-capitalized companies, which are category leaders. They have more than 12 months of cash when we enter the company. It's actually a pretty safe asset class. People, in their minds think that it's venture, so it's not really a good asset class. If you look at the asset quality, the loss ratio that venture debt has given over the last 7-8 years, it's actually less than 1.5%. And the risk-adjusted return is also north of 17%. So there are multiple reasons. Obviously, the supply is also limited, so you can cherry-pick the best of startups, but a host of other things that I mentioned.
So basically, as the tagline in an ad goes, "Daag achhe hai," venture debt also says loss achhe hai. Aakash, you recently did a successful fundraise in your private credit fund. Apart from doing financially solvent, EBITDA-generating companies, you're also looking at distressed situations. So you have Beauty and the Beast both in your fund. So what kind of value are you seeing in this space?
So we like the asset class, and we've defined our fund thesis to very clearly lay out what we will not do, right? So it's a very contrarian way of thinking. We've said if you look at the last 10 years, most wholesale capital providers have lost money in India, either in long-term project finance where projects have got stuck. So infra has been a huge miss and hit kind of situation. Real estate is where some people have lost money, some people haven't. So again, that's one, a little bit of a hit and miss situation. And then lending to asset light, low margin, low volatility, high volatility businesses is where we've found that there are most amount of losses or workouts required, right? So if you exclude these three areas, we've said all other old school industrials, asset intensive businesses which have an ability to withstand cycles, right? We like businesses that have obviously long gestation profitability, track record. We like businesses which have assets in the business. So a good combination of assets, what we call the 4 Cs, Lakshmi. So we've said character, just the quality of promoter, business, transparency, ethics, cash flow, collateral, and the fourth is credit structure, right? In the event there is a downturn and cash flow is reduced by 50%, do we have the ability to either sell this business? Will someone value it effectively? Do you think the business will survive a 5-10 year cycle at a lower margin, at lower sales, at lower profitability? And if so, if not, how can the promoter step in and solve the problem of the business, or do we have other assets we can get access to? If you put these together, there's a lot of industries we think this can apply in, but you'll find that it'll be in the realm of spec chem, pharma, steel, industrials, and so what we call old economy industries, right? We've stayed away from doing new economy industries, real estate, infra in a larger basket. And I think that's, for us, worked extremely well so far. We've, across 3 funds, invested almost $1 billion of capital with, touchwood, zero issues to date. And I think it's sticking to the box, right? And most people start off with a well-defined box, but over time, the box keeps expanding. And if you look at all global asset managers, everyone who's stuck to what their niche is or their USP is has been able to generate track record effectively over long periods of time.
So एक म्यान में 2 तलवार रह सकते हैं. So beauty and the beast can coexist, because this is the phase where we are seeing the metamorphosis, from the caterpillar to the butterfly, from the distress to कुछ मीठा हो जाए. Hemant, the infrastructure segment in India is seeing a massive boom, be it in equities or on the credit side, and as part of your portfolio allocation, you seem to be also veering towards that segment. So is that a sizable opportunity? Is it more nuanced, more topical? Any views on that?
Yeah, so I think similar to credit, infrastructure investing is called real assets. And I mean any asset, just think of it. So we don't do under construction assets because we don't have the capability to do that. We are not developers. But once an asset gets built, right, it's fully operational. If your counterparties are good, basically how are roads built? The government gives the tender, the developer gets paid 40% for the first 2 years, the road gets built. फिर government क्या बोलेगी कि मैं developer को in the next 15 years I will pay balance 60%. Now the developer has a small balance sheet, he cannot hold the road asset in his balance sheet for the next 15 years, right? But it's a cash flow paying asset, cash flows coming from the NHAI, it's operating asset. Effectively, what are we doing? You are effectively doing a bill discounting of 15 years. 15 years of cash flow getting discounted and getting paid to the developer today so that we become the owners of those assets. And those cash flows can be passed to our investors. So here, what we are seeing as a massive opportunity in this country currently is where asset ownership and capability will get decoupled. Historically, all the problems that have happened is when the developer thinks I am God, he constructs, he puts it on his balance sheet gets leveraged, but the asset goes away. And this is a very good example I keep giving to people. The Bombay airport still exists, right? But probably the developer that constructed that airport doesn't exist anymore. So the assets have fundamental values. At the right point, the asset has to move from the developer to an asset manager. So Lakshmi, in a long story short, we are monetizing the cash flows, contracted cash flows that will come in our operating asset and passing them to our customers. These are fully operational, and typically your counterparties will be the government in most of the situations.
So I think that's all the time we have with respect to this panel, but I think we tried to serve the perfect buffet for you, from meat to mock meat to Jenny food, from vegan to lactose free to all the dairy products. Since the discussion was on private credits, I want to summarize, since we had a few minutes, I just wrote down a couple of lines on private credit, which says, private credits are here to stay. Trend suggests it is the order of the day. However, there is a word of caution: if not researched well, could cause destruction. So make your choices and be clear. Intermittent volatilities are not to fear. So that's on the private credit part. I couldn't not write this short limerick. And since we are, part of this PMS Bazaar, the entire AIF and the PMS Summit, I want to just sign off on this note. There's this very interesting dialogue from Doom 3, which is the precursor or a prelude to the song. And this is true for the AIF business. And I have morphed from the mutual fund, public markets to AIFs on the private market side. And here it goes. बंदे हैं हम उसके, हम पे किसका जोर, उम्मीदों के सूरज निकले चारों ओर, इरादे